Hi, I'm James Robinson, and this is my stock thought of the week. In my ongoing series on how to value invest and in value investing theory, this is part 5. Again, as I said in the past, if you're going to be an investor, you have to understand accounting to some degree. It's the language of business. And that means you have to understand financial statements. So I've done a video helping you understand what's going on and what's happening with an income statement. That was part 1. Part 2, this part is going to be understanding balance sheets, how they are, how they work, what they are, and how you can, just a primer on how you can start to use that data to be a better investor. So as I've said, the language of business is math, and the type of math that's used in business is called accounting. Accounting has a series of documents that are standardized, that are used by businesses to report what's going on. Once that information is reported, investors use that and they thumb through that stuff and they analyze various components of those those statements to figure out what's going on with the business. The accounting that is done is very, very high level, right? Like you need to be a CPA to really understand this. And I'm not a CPA, and I'm certainly not a professor of accounting. And so while an accounting 100 level class might cover this material, you consider this an accounting 50 class. It's sort of halfway to where you need to be. And if you really want to be a serious investor, you should get much deeper into this stuff. But this is just meant to be a basic primer. And the reason I'm doing it is because I'm going to do a series of slides that help you to look at various components of a business. And that data is derived from the balance sheet and the income statement and the cash flows. And so I want you to get a sense for what all that stuff is, just so you have a fundamental, basis for discussion. So this is just an initial starting point. As I stated earlier in the previous video, there are 3 primary financial statements that businesses submit. They're mandated to do so. The first one is an income statement, or called a profit and loss. The second one is called a balance sheet. And the third one is called cash flow statements. The balance sheet we're going to go over today. A balance sheet is a financial statement that reports a company's assets, liabilities, shareholders' equities at a specific point in time. And that's important to recognize. When we talked about an income statement is what has happened over some duration. Typically, it's what happened over a month or a quarter or a year. So it's over the period of this year. How much were your total sales? What were your cost of goods sold? What were your total expenses? And what was your profit for that time period? But it's always over a period of time. A balance sheet is different. A balance sheet is what is the current state of your business as it relates to your assets and your liabilities. And so it's a specific point in time, typically 5 o'clock, the close of business on a specific date. And your balance sheet will change literally day to day with the company. They'll pay some bills, they'll get some income, they'll have some more money in the cash, whatever they'll do. But generally speaking, it's a relatively narrow band in terms of those changes. But again, the thing about a balance sheet is it's specific to a certain day. That's the first thing to understand. It provides a basis for computing rates of return and evaluating capital structures. It's also very important because it allows you to figure out the safety of your company, because the more cash it has, the more safe it is. The more debt it has, the less safe it is. So again, it's simply a snapshot of what's going on with the company on that specific day. In terms of the way it looks, this is a cool little chart that somebody at Investopedia, I guess Teresa Chiachi, created, so I want to give her credit. But this just gives you a sense for what's happening on a balance sheet. What it basically says is the assets of the company equal the liabilities and the shareholders' equity. Now that's done because shareholders' equity is hopefully positive and liabilities are a negative, and the hope is that those two will balance out to equal the assets. Without getting into all the explanation for why that is, what basically going to happen is you're going to see, when you look at the balance sheet, a listing of a bunch of assets. We're going to talk about what those are and why they're structured the way they are. And then you're going to see a bunch of liabilities, and then those two are very seldom going to equal out. And the number that's left over, the difference between those two, is going to be shareholders' equity, and it's almost always derived. So that's the basic fundamental look at what's happening on a balance sheet and why it's called a balance sheet. So a balance sheet has a number of components. Again, these are all done both by, there's something called GAAP, Generally Accepted Accounting Principles, and that's sort of the rules of the road for accounting, and they always follow the same structure. So the first thing that will show up on the balance sheet, and generally the way to look at an accounting balance sheet is it starts with what you could get your hands on the soonest, or what's owed the first, and working towards what's the later and later, further and further deferred obligations, or further and further valued assets. So the first thing you're going to look at is short-term assets. The definition for short-term is less than a year. So whenever you see something short-term or current, that means that it's going to happen in the next 12 months. So you have cash and cash equivalents. Obviously, that's just money that's in the bank or that can be instantaneously liquidated for an obvious cash value. That's the first thing on there. Obviously, you can get that instantly. The second thing is marketable securities. Marketable securities are stocks and debt instruments, typically governed by public companies, typically where there's a market for those things. Again, generally speaking, you can liquidate that within, say, 3 days and get your money. So that's the second item. The third item is accounts receivable. Accounts receivable is monies that are owed to you by other parties, typically by your customers. And generally speaking, accounts receivable you receive in typically 30 to 60 or 90 days is probably the right time frame. The next thing that's going to show up in short-term assets is inventory. Inventory is typically held on the books at its cash value, at its wholesale value. But it's the thing about inventory is that in theory you should be able to turn your inventory in some reasonable period of time and or liquidate it. So it does have, it is kind of low on the list of short term because you probably couldn't get your hands on it in 30 days, but you can get your hands on it reasonably quickly. The final thing is prepaid expenses. So if you were to go out and prepay 6 months of rent, for example, for some piece of equipment, then that would show up as an asset that you have the use of that equipment for the next 6 months. An asset is the right to use it because you've already paid the expense on it. Some of the stuff is getting more into the weeds than we will need to do for our analysis, but I'm just sort of giving you an understanding of the way that it works. So the next thing on here are long-term assets. So long-term investments, for example, you may take a position in a company that is, you have no interest in selling and no plans to sell in the next year, but you know the value of the asset. That would be a long-term investment. Fixed assets are plants and equipment and real estate, which oftentimes you plan on keeping for a very long period of time. Even if you wanted to sell it, it would take you some time to sell. Something to keep in mind about fixed assets is often they are not, the value reflected on the books is not the actual value of the asset. There's a couple of reasons why that is. First of all, it's impossible to tell, for example, what the value of real estate is to the next guy and when you decide to sell it. If you bought something, let's say Ford bought a giant piece of land to build a plant on, they're gonna carry that real estate on the cost of the land plus the cost to build the real estate. It may be that when they leave that plant, there's no buyer in the world who wants that plant. There's nobody who can use an empty automotive plant. Or it may be that there's 4 guys lined up to buy it and it's got a value that's significantly higher. Or they're going to bulldoze it and build condos, but that value is way higher than Ford was able to derive from the property. So fixed assets are a kind of an interesting look in terms of, and not very valuable in terms of figuring out the value of your company. The next one is intangible assets. So intangible assets are things that, for example, patents. Another thing is goodwill, the value of your logo. Some of these things are carried on your books, and some of them, interestingly enough, aren't. Generally, if you create it in-house, you don't carry it on your books, and if you purchase it, then you do get to carry it on books. So if Apple buys a company and gets some patents, then the value of those patents show up as intangible assets. Coca-Cola does not get to include its logo as one of its assets, even though it's infinitely valuable because they developed that themselves. So the reason I'm going into this is for our purposes as investors, and probably small investors, we don't have the time, energy, or expertise to really look at everything that's going on the balance sheet. So I tend to look at long-term assets and maybe a little bit of fixed assets, but I don't look at all of these things. The next section of the balance sheet has to do with liabilities. Liabilities are simply monies that you owe somebody, obligations that you have, future obligations that you have. Same thing as with your current, with the balance sheet, we start with what's either the easiest to liquidate or what you owe first, and then we go to the longest term, what tends to be the longest term obligations later. So first we'll start with current liabilities. The current liabilities are the current portion of long-term debt. So think about it this way. If you have a mortgage, you're supposed to pay off the mortgage over the next 30 years. And your balance sheet under current liabilities would be the next 12 months worth of mortgage payments. So not the entire mortgage, but the amount of mortgage you have to pay in the next 12 months. Next is bank indebtedness. That's just other loans that you have. Any interest payable, that's interest payable. And the reason for that is interest is typically payable at the very latest on a quarterly basis. So it's being accrued every day. Once it's owed and obligated, then it's a very short-term obligation, and therefore it shows up as a current liability. Any customer prepayments, maybe the simplest example of that would be somebody who bought a gift card, and the idea is at any moment that customer could cash that gift card in, and so while you've currently got the money, it's actually a liability that you have to give somebody the goods or services that the gift card is associated with. Dividends payable, so a company will often announce that it's going to pay a dividend of a certain amount on a certain date. Once that announcement is made, that money is now owed and payable, so that shows up as a current liability. And then accounts payable, that's for the operating your business. So you've got to go and pay your copier bill, for example, or your lease on your copier payment. That would be a current liability. So long-term liabilities, which is obviously anything that's more than 12 months into the future, the best example of that is the long-term debt. So again, using the mortgage analogy, it would be the period of the obligation of the mortgage that wasn't covered by the next 12 months. But any other long-term debt that you might have, especially for companies, they'll often have bonds outstanding that have to be that will mature in 15 years. So that would be a long-term debt. Pension fund liability. The idea is that you have to be putting money aside for your employees to retire on. There's a certain amount of money required to do that, but you don't have to pay it today. You just have to pay it by the day the employee retires. So that's a long-term liability. Also, deferred tax liabilities. Now, again, all of these things are gross oversimplifications, right? There could be any number of items, and every one of these items would have multiple categories, and an accountant would tell you, well, this should be treated that way, and that should be treated the other way. That's all well and good. It's not really what we need to worry about for investors at our level, but that gives you just the basic structure of the balance sheet. So again, it's current assets, which is assets that are easily liquidated within 12 months. It's long-term assets, which are assets that are likely to take more than 12 months to liquidate. It's short-term or current liabilities, which are liabilities you owe in the next 12 months, and long-term liabilities you owe in more than a year. So those are the two primary components that people look at in a balance sheet. There's another section, and we're going to talk about that next. The final part, and part that confuses people a little bit about the balance sheet, is the section called Shareholders Equity. And again, I would consider that to be sort of irrelevant for your analysis purposes. All that really is the numbers that are needed to balance out and make the assets and the liabilities. It's just the difference between those two. It's a little more complex than that, but for the sake of oversimplification, I would say that's the way you should look at it. So what's in there is really retained earnings. There's sometimes a slot for preferred stock or common stock. There's sometimes a section for paid-in capital. But I don't think I'm oversimplifying things too much when I say you want to understand what shareholders' equity is for other things we're going to do, but for how that's all calculated, I'm not sure it's important to really get into the weeds on that unless it's something you're interested in, and then go take an accounting class. You don't really need to know that for what we're going to be doing together as I start helping you work through the way I see value investing going. So that's basically it for income statements, for balance sheets. Hopefully that gives you some foundation that we can use to build on. The next video I'm going to do in a couple days is on cash flow statements and what that's all about. And then we're going to start utilizing that data to really get into the weeds on what's going on and how I analyze stocks. So hopefully you hang around for that stuff. Thank you very much for your time.